Today we're talking about if you're a South African or South African family that's moved abroad and you're thinking about coming back. Uh, we are in 2024. The world looks completely differently than 3-4 years ago, and literally on a daily basis, our tax and immigration practice gets asked the question: uh, if I'm looking at coming back to South Africa as a South African that's moved abroad, what must I be aware of? Now, obviously, the reasons are very diverse. We still see a huge amount of South Africans moving abroad, especially young professionals, especially ultra high net worth individuals that worry about the state duty implications. But we also see a lot of South Africans moving back. And I think the reasons for that move, it's kind of common knowledge. It is around perhaps lifestyle. It's about the cost of living abroad. I know they say nobody moves for weather, but if you've been in winter in Europe, you know it's no fun. If you move abroad, uh, if if you are abroad and you you've seen that extreme cost of living, and you compare it to South Africa and the just the type of accommodation you can get, the cost of living that's so low for the quality of life, it just makes a lot of sense. So if you've moved abroad and somebody asks us to say, I'm coming back, uh, we obviously say, listen, before we get into too much depth, let's first look in terms of how does the South African regulatory authorities see you? And that very much depends in terms of when did you leave, uh, is your tax up to date, what does the master's office have to say about you, what is your status per the Reserve Bank, did you keep a bank account open in South Africa, what's the status on that bank account, is it classified as a resident or a non-resident, what does the CIPC office see about you? And we kind of like to just bundle that together to say, let's call that a diagnostic, that we just kind of have a look at what does the system show as your status. And obviously, the ideal status is that you have properly exited South Africa, that you are duly classified as a non-resident before you come back. Uh, because if you've not classified as a non-resident, as far as SARS is concerned and the Reserve Bank is concerned, you might still be staying in South Africa and you've just disappeared off the radar. And obviously, if there are certain things then that has not been well attended to, even if you were guaranteed by your tax advisor or your accountant that they filed all your tax returns and that it was done correctly, even if all of that has been done, you know, you've got an email that shows that, that's not what is important. What's important is what is on the SARS system and what is on the banking system. And if your status is not correct as a non-resident, kind of the step one is that you should correct your status to be a non-resident on record. That your status aligns with your facts, that you've left South Africa with a permanent intention a certain number of years ago, whether it was as a student, whether it was as a young professional, whether it was close to retirement for the last job that you took abroad and you thought you're going to retire abroad, but you realize the grass is perhaps not greener on the other side and you rather come back to South Africa. Then once that part has been caught up, it's important before you come back that you appreciate that it's a rare opportunity to structure your affairs correctly before you re-enter back into South Africa. And with that we really mean is that we kind of want to have a look at what are your statement of assets and liabilities that you've got before you come back to South Africa. And how much capital are you bringing back to South Africa? So obviously, typical family that moves to South Africa, even if you're not South African, very often people simply purchase a home with their capital because housing is very affordable. Uh, I was again last month in Europe, and it is just worlds apart what you can buy there as the most humble small apartment in perhaps not a great location in South Africa. You can have an incredible standard of living for the same price, and and for some families that's important, and they make that acquisition of a property. And you are absolutely allowed to make an acquisition of a property. The fact that you're buying a property in South Africa does not change your tax and your exchange control status if you do it correctly. And what I mean with doing it correctly is that you must enter that money on a correct basis into the South African tax system. So we will we will normally ask to say, give us a list of your assets and liabilities for you and your spouse. We will have a chat to understand just what are your unique complexities. Are you going to work for a foreign company in South Africa? Are you are you going to draw on a retirement? Obviously, a correctly structured pension fund that you receive into South Africa from past employment is still exempt under South African law if you bring it incorrectly. Again, the emphasis if you bring it incorrectly, it's a very narrow exemption. So tax law works around the world on the basis that the law pretty much taxes everything. And then there is certain things that we would call a carve out. And a carve out means a very narrow thing that it exempts from tax. So do you get perhaps a foreign pension? Do you get foreign rental income? What capital do you have? Do you have a foreign share portfolio? Do you have an offshore trust? Do your family have an offshore trust where you might have settled the trust, or you one of the current beneficiaries or the future beneficiaries of that? Do you have offshore companies or an offshore company, which can be either in a normal jurisdiction like UK, US, or anywhere else, or perhaps in an offshore location? The term really these days is, are you the UBO? Are you the ultimate beneficial owner? And pretty much once we've got our arms around the complexity of your personal affairs, we come up with what we, in simple terms, just call a roadmap. And a roadmap simply is that you you kind of don't pay school fees by making incorrect choices in terms of what you bring into South Africa, what should you leave abroad, what should you wrap into a structure, and what should you, for example, keep into your own name. For example, if you've got a foreign property and you're going to rent that out, that property will always have to first pay tax in the country where it's located. There's no double tax treaty that South Africa has entered with a foreign country where we will have the right to have tax on that property first. The country where the property is located, that country will have what you call the first taxing right. And then if you become tax resident in South Africa, obviously with planning, you can use the days test to 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 stretch when you become tax resident in South Africa, depending on your tax status. If you become resident, you have to declare that foreign rental property in South Africa again. And what, in layman's terms, you can call South Africa's got the secondary taxing right. So South Africa can also tax that property. And then, of course, I think as is common knowledge, there's no such thing as double tax. Double tax is not allowed. So South Africa must then give a credit for the tax that you have paid in the other country. And obviously with planning, you would try to make sure that if you've paid tax in the other country, you would not want to pay more tax in South Africa. A common misconception is what one can call the remittance basis of tax. Uh, a lot of people believe that if you keep your money outside South Africa and do not remit it into South Africa, then it's not taxable. That is incorrect. The remittance basis of tax, it is something that comes from the United Kingdom. It's part of the UK law. It finds a very narrow application under a non-domiciled UK individual. And I presume because we're part of the Commonwealth, and obviously UK law has heavily influenced common law, tax law, Canada, Australia, and the like, New Zealand. That's why a lot of our international tax refer to similar law in those countries and how it got interpreted. There is a remittance basis in the UK, but it's not in South Africa. If you earn money worldwide, whether you remit it or not, and you are a tax resident in South Africa, you must declare that for tax purposes, whether you bring it in or not. Obviously, if you're a non-resident, you do not have to declare it and you do not have to pay tax on it. And this is not just as simple as whether you have to pay tax on it from an income tax perspective. You also have to pay capital gains tax on that when you dispose of it. Obviously, you need to make sure that you get your values of your assets right before you become resident in South Africa, because that's going to be the base costs, as tax calls it, of your asset. So when you sell it, you will only pay South African tax on the increase of value. In other words, what it was worth when you became resident and your proceeds, or what you got when you sold it. So you need to look at the value of your assets. And of course, before you become resident, you must be cognizant of South African estate duty, which above the highest level, it's 25%. It's on your worldwide assets. So if you are a higher net worth individual and you come to South Africa with too much assets in your name, you've not wrapped it into a family structure, and there's various structures that's legally allowed for. There's SARS rulings on some of these. Then if it forms part of your estate, obviously you will have 25%, or your executor will have to pay 25% tax on your estate, and your beneficiaries, or those that inherit from you, will only get the balance. So South Africa is not a good place to come and retire without a structure if everything is simply in your name. And that is where simple planning comes in. Now, of course, it's very easy if you've got a share portfolio, equity portfolio, crypto, a business, through restructuring to put those type of assets into what one can just call a wrapper. A wrapper is basically just a family vehicle that wraps it into a corporate legal persona that's not yourself, which is shielded from tax. But if it's a fixed property, of course, it's far more complex to move a fixed property into a company or into a trust or into another form of a wrapper, because that comes with, in the country where you're transferring it from, obviously their form of transfer duty and transferring attorney costs to move it from your own name into the structure. So that's normally why properties will not get moved. So I think it's fair to say that if you come back to South Africa, the simple steps are: make sure before you're here that there's a diagnostic in terms of not what is our opinion or your current or past advisor's opinion on your tax or your fiscal status. Get an objective view on what the system tells you the status is. If there's cleaning up to do, clean it up before you come to South Africa, or at least start the process. Uh, Start with a clean slate. Have a clear statement of assets and liabilities and a well-planned approach in terms of how you come in. Make sure that you you are well planned and do it in a correct way. If you bring money into South Africa to purchase a property, a farm, a beach house, all of those things are allowed. To purchase vehicles, it's all possible. You can keep your foreign assets, look at whether you should structure it correctly, and make sure that the way that you receive your money into the future is in a tax efficient manner. If you, for example, as a resident receive foreign dividends, they are taxable generally, except if you fall under the participation exemption, then foreign dividends are tax free. If you receive interest from abroad, the interest is fully taxable, up to a maximum current tax rate of 45%. If you receive a capital repayment, it's completely tax free. So it's very easy to have an incorrect classification if you're a bit sophisticated and then fall in a bad tax spot if you're not well planned. And then obviously when you come to South Africa, make sure that you've got a South African will. Make sure that you try and, to the extent legally possible, stay out of the South African residency test. We are not like other countries where you become resident from day one if you spend more than 183 days in South Africa. That is the rule in the US, Canada, Australia, even UK. South Africa has got a far more lenient or more strict rule depending on your circumstances. But you do not automatically just assume tax residency. And then, obviously, if you are going to work in South Africa, very important, look at the cost structure of how you set yourself up. To set up a South African company, it is very cheap compared to international locations. It's efficient. The compliance burden is quite light in our view compared to certain other countries if you do it correctly. But to sit in South Africa and run a foreign entity, especially if you're resident or even not, if you are the sole kind of operator or person that effectively manages and controls that entity, you fall into a host of anti-avoidance provisions, which you will try to stay clear of that if you are aware of how complex those things are. And again, what we often see is people come in, they ignore it at their peril, they get away with it for 3-4 years, and then one day a transaction gets picked up and SARS goes all the way back to the beginning and look at their stuff from day one. We live in an era where you cannot hide information. It's freely available. Your bank records do not disappear. Your transaction history do not disappear. It's in the system. So you need to approach it in an intelligent way. I hope this is helpful for those coming back to South Africa. Perhaps kids is entering a new phase of life. Perhaps you are retiring in South Africa. Perhaps you're just making a lifestyle change to still earn abroad but base your family here, or whatever your reason might be. I hope it kind of puts you on the right path. And even if you've left South Africa not planning to come back, but you are getting an inheritance from South Africa, money or a property, or you want to perhaps just acquire a property in South Africa because it's still affordable still compared to the rest of the world as perhaps a family property, I think a lot of these principles find application, and it is some useful tips in terms of where to start, and what typically should be looked at before you pull the trigger and make the decision?